everyone, happy Tuesday the 6th of August, and apart from a few logistical reasons to do this video on Tuesday instead of Monday, I also wanted to wait and see how the market would respond to Friday's and yesterday's price action, I guess. Obviously we all know what happened. Started last Friday, and then yesterday on Monday we got a big decline followed through, led by Japan, and then after that Europe actually declined seriously, and then the US followed. What happened in the US was interesting, because we kind of declined and then we bounced back up. And in times like these, I always like to step back and take a look from a bit higher level to see how things are playing out. It's never a good idea to kind of panic in the middle of a panic. That's a good one. Don't panic in the middle of a panic. But I mean, you want to be prepared for a move, and I think we had like the word caution was all over, all the stuff everywhere over the last few weeks. And I'm not going to say we saw it coming, but there were plenty of signals, little signs that market was overbought, very narrow breadth, narrow foundation, all that stuff, and then it needed some sort of a catalyst to actually start declining. And now we're in the decline, and you want to start to gauge where the decline may stop. And hopefully we're going to build a case to kind of paint a scenario of how and where that could be. And I'm recording this on Tuesday daytime in Europe, and when the US kind of stalled last night and then bounced off its lows, what you saw in Europe and in Asia is that markets bounced. So when I woke up this morning and the markets opened, a lot of the quote screens were green, and now it's 2 p.m. and everything's turning red again. And that's the stuff that I'm interested in, because it is the way a market responds to such a decline tells you a lot about how things are likely to go and follow through. Let's kick off with a quick RRG, of course, like sector rotation in the US. And things are happening fast, and that means that the rotations that we've seen over the last few weeks are still there. Obviously, the rotation out of tech was very, very visible, and what you see is basically the tech led the decline. Everything else was either inside improving, turning back up, or even if it was inside the lagging quadrant, started to turn up a little bit. And then we had utilities in weakening, and you can see how they kind of jumped back. So the rotation out of tech is ongoing, it's undeniable, and it looks as if everything now is getting better than tech, but that changes when you look at the daily RRG. So it shows us a little shorter term outlook. And here you can see how, this is tech, how consumer discretionary has joined tech inside the lagging quadrant. And you can see how a lot of other stuff has rolled over. So financials, industrials, here's energy. And then there's a few that are improving. This is utilities, this is healthcare, this is staples, this is real estate. Real estate is doing really, really well. And then materials turning right, and here is communication services moving into the leading quadrant. Now, that's from a sector level. If we move one level up, usually we go down, but if we move one level up, we can see some interesting rotations. Let's start with growth value. The growth stocks have been rotating out of favor for 1, 2, 3 weeks ago. It really started to show up, and value is as usual, doing the opposite rotations, because this is a closed universe, so they should move in opposite directions, and that's what they do. So here you can clearly see the rotation out of growth and the rotation into value. What you also see is that growth is still way on the right-hand side and value is still way on the left-hand side. That means that the longer-term trend is still in favor of growth stocks. So for the time being, this is a setback within a longer-term uptrend. Let's see how that plays out on the daily RRG. When we look at that on the daily, you can see the rotation into value, and that's what you saw here. It's the last couple of weeks that we were showing on that weekly, and it coincides with the decline in the S&P, or in the, this is the Dow Jones US index, this is total US stock market. And you can see how value picked up. You can also see a very nice RRG velocity picking up. That's when the tail gets longer. So here there are short tails, which means that the trend is stable, and then all of a sudden, half through July, the tail starts to lengthen, and that's an increased RRG velocity, and it measures the distance between the nodes on the tail. And then it rotates into a leading, and now you can see the near term, that value for the last 3 days lost a little bit, and then as of yesterday, it started to turn to the right again, and growth started to turn to the left again. So the near term, still pretty much in favor of value, and it's going to be the question how strong this value rotation will be, whether it'll be able to turn that longer term trend in favor of growth stocks around. If we bring in the size segments, and we have size here, you can see large cap, small cap, and mid cap. And everybody was talking about the great rotation, and what they talked about was the great rotation into small caps. And that great rotation lasted literally like 1, 2, 3, 4 weeks. And this is what that great rotation was. Here also, you still see that large caps are inside the leading quadrant. They lost a bit of momentum, but they're still on the right-hand side of the graph. Mid caps and small caps are very much in tandem. They're very much alike in their rotations. And you can see how they are picking up relative momentum on the y-axis. This also changes when you switch to a daily graph of this setup. And you can see how that rotation, let's play that great rotation out. So this is half July, July 12. You can see here how small and mid caps started to pick up. And large caps moved into lagging, and now they're rolling over a bit. So now here you see how mid and small caps are losing momentum and large caps are picking up again. And then the final slicing and dicing of these universes, basically bringing them together in the growth, value, and size RRG. I unselected the bigger ones, so large cap, small cap, mid cap. The overall index is now gone. Growth and value is now gone. And that leaves us with 6 tails. So it's value for large, mid, and small, and it's growth for large, mid, and small. And here is an interesting setup, because we see that large cap growth is the only one inside the leading quadrant. It's still there, it's rolling over, and you can see how all others are picking up. And if we look at the daily RRG for this setup, we have again the same 6 tails, and you can see how large cap growth is now inside lagging, but it's starting to bend to the left again, moving lower on the RS ratio scale. But here is something interesting. So we have mid cap growth, inside improving, but not doing much, ticked a little bit to the right, very short tail, meaning that there is very little momentum behind this move, so that's going to be stable. Then we have small cap growth, that's this one here, and it's moving lower. Then we've got large cap value and mid cap value, and you got small cap value. And the interesting thing is that the the small cap growth and small cap value are continuing their loss of momentum, and large cap value and mid cap value have started to move to the right a little bit, together with mid cap growth, but that's really on a lower scale. So the rotation out of large cap growth now seems to be moving to large and mid cap value and not so much small cap value. Small cap growth is out of the picture, and in a way so is mid cap growth. So if I resume that, we have to conclude that money is flowing out of large cap growth and it's moving into large cap value and mid cap value. So the money is also moving out of small cap growth, small cap value. So the rotation is dominated by a move out of large cap growth into large cap value, mid cap value. So from a size perspective, it also tells us that the rotation to small and mid caps has come to an end. And the defensive move to large caps is picking up again, but it's large caps value this time, not large caps growth. I hope that makes sense. I hope that the images are actually better at telling the story than I am. So if we now go back from that growth value size rotation, higher level, back down to sector level, I want to break down the sectors into large cap and small cap, and then go over the offensive, defensive, and sensitive groups of sectors. So here we have the large cap cyclical, large cap offensive sectors, and here are the small cap equivalents. And what you see is that everything is on the left-hand side of the graph, so they're in relative downtrends versus the S&P 500. But there is a clear improvement, especially for the real estate sector. And you can see how financials, materials, and consumer discretionary have picked up over the last few weeks. These two are still inside lagging, and you can see how consumer discretionary is starting to lose pace. And what I'm looking at is the length of the tail and the distance between the nodes, and it's getting shorter. So it means that that move is running out of steam. So it's got, compared to real estate, I think that consumer discretionary has higher odds of rolling over while still inside the improving quadrant and rolling back down towards the lagging quadrant. If we look at the small cap equivalents, you can also see a strong move for ROOF, which is the small cap real estate ETF. You can see how small cap financials are way better than large cap financials, PSCF versus XLF. And you can see how small cap materials are much worse than large cap materials. Here you can see how large cap materials are picking up, small cap materials are moving lower. Remember what we talked about, the defensive move back into large cap? So this is the cyclical group. It's probably the worst group inside from a sector perspective at the moment. And even though materials are picking up, you can see how they are still the weakest sector in this group over the last 10 weeks with a minus 3.4, and it's picking up because this is all relative. And here you can see how materials are way worse than anything else in this group of small caps. By the way, we're measuring here against the small cap index and here against the S&P 500. If I would make this SPX, you can see how much worse this rotation is. Now everything is on the left-hand side. So the small caps are way worse than when I compare them to the small cap index, SNL. Here you go. Just to make the point that the move is taking place out of small caps in general, and these two, because I'm comparing it to small caps, are standing out. If we compare it to the S&P, they're all to the left. If we move on to the defensive group of sectors, and that is traditionally healthcare, staples, and utilities, you can see how over the last months, that rotation was actually moving out of defense. And that was a bit, I don't know, it was unexpected, because this sector already went through a rotation into strength while the market was still moving higher, which is usually the prelude into something more weakness. That didn't happen, so these sectors started to rotate out of favor. But now, all of a sudden, they jump back into favor. So healthcare, staples, and utilities are now all back into that 0 to 90 degree heading. And if I look at the small caps, we can see a similar move, a similar rotation, where they are now all on a positive trajectory. And again, let's put this one against SPX. And you can see how they're now all to the left-hand side, so much weaker than what you see here, especially in terms of utilities. But they're all inside the improving quadrant and at a strong heading. So the strength for defensive sectors is definitely there. And you can see how especially large cap utilities are doing better than their small cap counterparts. Healthcare and staples, not yet. I'm going to say not yet because I don't know how this is going to play out in the next couple of weeks. And then finally, we've got this group of sensitive sectors, economically sensitive sectors. And here we see how the dance is led by the rotation out of technology. Industrials and energy were already way deep inside the lagging quadrant. They've been picking up a little bit of momentum. Energy is already starting to move to the left. And you can see a slight improvement for communication services. If we bring that over to the small cap area, first of all, you notice that there are only 3 sectors here. And that's because there is no small cap communication services sector that's included inside technology. And you can see how much weaker that rotation of the technology sector in small caps is, and how industrials are moving to the left and energy is already leading the dance into the lagging quadrant. So here also the rotation much stronger out of small caps and inside large caps. There's even a little bit of improvement visible for communication services. If you really want to look at it from the bright side, maybe also industrials, although it's a bit too early for me. If we sum this all up, I think that the conclusion is going to be that the move to small caps is stalling. It is going back, money is moving back into large caps. But that is a safe haven move. It's a more defensive move. People tend to move to large cap stocks, stuff that they know when the going gets tough, and they are relying on those big names to save them. So the speculative money is rotating out of small and mid cap once again. If you look at it from a growth value perspective, it's very clear that the rotation out of growth is ongoing and money is now moving back to value. And as I said, when you combine it with large, mid, and small, it's especially large and to a degree mid-cap value stocks that are preferred. Small cap value, small cap growth, all rotating out of favor. And then if we move to a sector level, you can see how the move to more defensive sectors is starting to pick up again. And that move is stronger in the large cap area than it is in the small cap area. I think that kind of sums it all up. And what does that mean for the S&P 500? First of all, the relationship between stocks and bonds. 2 weeks ago, July 26th, I wrote a blog article where I looked at that relationship, SPY versus IEF, and I noticed a break from the channel, the negative divergence in the RSI that just was executed. And if we look at that chart right now, here's the updated chart, you can see how that's now really accelerating. So, I mean, 2 weeks ago it was already, pretty clear, but now it's very clear that bonds have to be preferred over stocks. We may see some bounces here and there because it's almost a straight line down, so it would be very normal to see some sort of a bounce back. But this trend, this structure of this market has now changed, at least for the medium term, in favor of bonds. And even if it stalls here, it's probably going to go sideways. I don't think so, but if it happens, it's probably going to be, you know, the maximum that you can get here for the next few weeks is sideways at best, in my opinion. And that's based on the break from this trend line, the break below numerous horizontal support levels, and the executed divergence between price and the RSI now dipping below 30. So from a stock bond perspective, we do have to be aware of the fact that bonds are now the preferred asset class, even though the rise in bonds means lower interest rates, which usually is a good sign for stocks, but it doesn't look to be like that at the moment. Other factors are in play here. And when we move to the chart of the S&P itself, and here is the daily version of that chart, you can see how we broke this trend line and the old support acted as resistance. And after the break of horizontal support, we started accelerating. And this is yesterday, Monday the 5th bar. And it's, look at where it bounced, exactly at the low, which was the previous high here and a cluster of highs and lows back in March. And we actually closed the day higher than we opened, so around 517. A very plausible scenario would be for the market to rally back and close the gap. What's going to be pretty crucial in the next few days or weeks is where the new high will be set. Not sure whether this is going to be the new low. Maybe we dip further, but with this situation of lower highs and lower lows in place, we're going to look out where is the next low, and then especially where is the next high, and I'm going to assume it's going to be a lower high. Where is that going to be formed? How high are buyers going to push that price before sellers are coming back in? And the rule is that the lower that high will be formed, the weaker it is for the market, because it means that the sellers are very aggressive. They are not willing to let the market rise back to a previous higher low, which can act as support or resistance. When the market rallies and you see immediately selling coming in, that's a weak sign, because the sellers don't want to wait to get rid of their positions and don't want to give that market time to rally a little bit further. And when we move lower, it's interesting to see where the new low comes in, because that's an indication where buyers are willing to start tiptoeing back into the market and start to pick up some stocks and see how high they can push it. So that's what I'm going to monitor on that daily chart. Probably a more interesting chart is the weekly version, is the weekly chart of the S&P 500. And this is a chart that I don't know when I annotated this, but it's been in my list for quite a long time. And this was the last annotation that I added up there, is where we put that higher low in place, exactly against that former rising resistance line that started to act as support. We made a new high, and now we're tanking back, and we're ended right at that former resistance line, which is again acting as support. So the question is, how strong is this support line? Will it be able to hold that selling and keep the market afloat above that? And here you can see what was a series of lower highs and lower lows on the daily chart. It's a straight line on the weekly. Thinking ahead, thinking into the future, if this holds, where is that next high going to be? I mean, I could argue that on a bigger scale, this is a low, this is a high, this is a higher low, this is a higher high. And if this holds, we've got another higher low, which would mean that the uptrend is intact and we can move higher from here. That's a very plausible scenario, but we do need to hold here and we do need to monitor that on that daily chart to see how it's going. Again, there's a lot of overhead resistance, and where that new low is going to be formed and if and where that new high is going to be formed is going to be very important. I've added a question mark here because what I've noticed over the years is that when you have a situation like this, and when at some stage that market drops back into that former channel, so in case of SPY, when SPY drops back into that former rising channel, and I don't know whether that's going to be happening this week or next week or the week after or maybe somewhere here, I don't know. Very often you will see a follow-through of that decline to the lower boundary of that channel. And you can see that's a big move for the S&P 500. So if that happens in the next couple of weeks, then I'm going to put my target for the S&P 500 for SPY in this area where 2 or 3 support levels are clustering. First of all, it's 460, which is the horizontal level formed by the peaks going back to March 2022, July 23, and then it was broken, and then it coincides with my rising support line here. So that's around 460. That line moves up over the next couple of months to 470, 475. And then there is another horizontal support level around 480. So the area between 460 and 480, starting somewhere in September, is going to be my target area if and when the S&P dips back into that former rising channel. For now, we got to wait and see how the next lows and highs are going to pan out on this weekly chart or that daily chart that we just looked at. Exciting times. The easy money, just buy semis and you'll be fine, seems to be over. And it's going to be more difficult, but that means that we've got a lot to talk about in the coming weeks. So stay tuned, and I'm looking forward to seeing you again next week, same time, same place.